Hey everyone, welcome back to the REI Marketing Secrets Podcast. Today on the show, we have Corey Harrelson. And Corey, for our audience out there who's just learning about yourself for the very first time, do you mind just digging into your background a little bit and how you got started investing in real estate?
Yeah, super excited to chat with you today, Trevor. Yeah, absolutely. So I was, prior to doing this whole crazy real estate adventure, I was a structural engineer, so designing buildings for architects. And about, I guess it'd be 9 years ago now, 2015, 2014, my wife and I had our first child, Max. And in 2015, I was getting to the point where I was getting pretty burnt out. I was working 60 to 80 hour weeks as an engineer. I would oftentimes leave home before my son woke up, get home after he's already in bed. So I was really not getting very much FaceTime with him while he was actually awake. And it was getting to me. And then there was one week in particular where it was a week straight where I didn't see him awake. Like I was gone early in the morning, came back really late, woke up the next day, do it again. It was a really big push. And it was, I think, a Sunday after about a week of this. It was about 5 p.m. And I was like, forget this. I'm dropping this. I'm going home. I'm going to go put my kid to bed. Gosh darn it. And so I go home and I go to take him from my wife to go give him his bath and like spend a little time with him, put him to bed. And he looks at me like I'm a total stranger, just freaks out, like stranger danger. Why are you taking me from my mom? Like he was probably like, just how old was he? 1.5 or something. And it like kind of killed me. It was really, really rough. And so that's when that was kind of my, like, I have to do, like, I can't do this until forever. Like I just felt like so overwhelmed and like powerless. But so I made a decision to do something. So then I started doing blogs and books and all kinds of things. Somebody gave me the book Rich Dad Poor Dad. It's the same book that like pretty much everybody I think read. But it was like, oh my gosh, assets that pay you. Like why did I have to wait till I was 35 years old to think of this and read it in a book? It's not that complicated. But so anyway, that's when I decided, my wife and I decided we're going to invest in real estate. We're going to so we committed to savings. We weren't saving very much money at all before that. We were going out to eat 3 times a day and just basically we weren't going into debt, but we were just spending everything we made. So we got really intentional with our savings. We got to a 50% savings rate. We accessed some HELOC in our house and we said, okay, let's go try and buy a rental property. And we were looking for duplex, threeplex, fourplex. And I'm an engineer, I'm a nerd, so I made a spreadsheet to analyze them. I learned how to do a pro forma. I'm analyzing a whole bunch of deals, and I got pretty discouraged, even back then with just the cash flow you could get from a normal rental. I know I could have like driven for dollars or something and got a good deal, but I wasn't like, I was kind of losing my zest. And then I stumbled on a mobile home park for sale on Craigslist. It was a little, I didn't end up buying that one. It was a little 9-lot mobile home park, and I punched that into my spreadsheet and was like, oh, these numbers look much better. And so I kind of, then I started asking questions and learning and diving in and kind of went down that rabbit hole from there. And we bought our first 12-unit park in 2016. So yeah, kind of found it by accident.
I like that, finding it on, or obviously you didn't go through it, but the one on Craigslist. It's funny to think of Craigslist nowadays going back, going finding
Yeah.
it. But and I agree with you there. I take a look at like a lot of multifamily deals, even myself, and I'm a passive investor, but looking at these active deals, I'm like, this is kicking off like $200 of cash flow for like maybe $100 per unit, maybe $400 a unit, or 400 on a duplex, so $200. I'm like, there's still a lot of risk, and I feel like there's a lot of time involved, and especially in multifamily. I mean, let's say the water heater goes, you're looking at maybe $2,000 for that. Maybe if it needs a new roof, I mean, that's coughing up your cash flow for a very long time. But when it comes to like the mobile home park space, how is it compared to the other asset classes that are out there? Are you just owning the land and the person's bringing in their mobile home? Are you both, let's say you're owning the mobile home itself and then doing like a seller financing or leasing it out? Are you doing both? Or just curious, because I feel like it's different than like other types of real estate where if I own a multifamily, I own it. But I feel like in mobile home parks, you could own both the unit or the mobile home itself and then also the land underneath it, and you're renting out the lot space. So just curious how it works within yourself and your company.
Right. So, yeah, I think you hit the nail on the head with it. The thing that makes mobile home parks unique from other multifamily is that typically, say 90% of operators, and I count myself in that 90, will prefer the type of park, the model where it's called a land lease community. So the resident owns the home and we own the land under the home. And so they're paying rent for that. It's basically a parking space to keep their home on. So it's much, much lower rent than they would be paying in a whole apartment, because we're not, they're the ones, they're the ones providing the home for themselves, right? And then we're just providing the land. And so it's cool in several reasons. One of them is from a maintenance perspective. If there's a leaky toilet, it's not your toilet, right? It's their toilet. And that's actually a good thing. One of the reasons I like this model much better than the park own home model is, especially if you own a couple rentals. I know of a few operators who like the rental model, and they'll have a park with a whole, or they're all rentals. It's basically a horizontal apartment at that point. And then it's generating enough income that you can have a full-time maintenance person there to address all the issues. But what happens when you have just a handful, you have some, you maybe don't necessarily have enough revenue to have a full-time maintenance person. So you have to hire, so there's weather stripping and you got to go hire a contractor to fix it. So it ends up being not cost effective. So the tenant owned home model though, if they own the home, then really what we're just doing is the landscaping, making sure the water line, the sewer line, the infrastructure is us. So there is still some maintenance. You have to get to snowplow contract to plow the roads in the winter if it's somewhere where it snows. But the maintenance, is drastically less, and the issues that you can have are drastically less. So, and then the other big benefit to that is you're both owners. They own the home, you own the land, so you're kind of in it together. So most of the residents in that scenario want the community to be nice. If you can come and find one that's under maintained, usually they get pretty excited once you start making improvements. And so it's you're all kind of invested in the community, and people tend to stay a long time. The statistic, I forget who did the study. Someone did one of the big, huge operators did a study of a whole bunch of their parks and found the average length of stay for a tenant was 14 years compared to, 1 or 2 years in an apartment. So, and then another benefit of it is if the tenant leaves, they've got equity in their home. So typically if they will want to sell their home. So they will find your next they'll find your next resident for you. So they'll still have to pass a background check and everything to live in the community. But we still have all the same like tenant screening and everything criteria. But they'll find the next resident, sell the home to them. So it's more often than not when someone leaves, they move out on the 30th. The new person moves in on the 1st. So you get a 0-day, 0 cost turnover. So that's another kind of benefit that to the tenant owned home. So yeah, it's sweet. It's a cool model.
Yeah, I really like that aspect. And I think like you mentioned, like apartments where if I want to move, like me and my wife did, we moved around a couple of different times before we bought a house, and stay in about 1 or 2 years in each apartment. Where I feel like if I owned a mobile home and I was living in it, it's either I have to go move and sell it, or I take it with me, which I'd imagine that's a whole big process if you're trying to move the entire mobile home park, or not the park, trying to just move your entire mobile home to a new park. I would imagine that's a massive undertaking. And I do like it where I feel like people that own it are just going to take better than someone that's renting it. And I think it's just like apartments, like most people are probably going to take better care of their own home than when they're just renting. So I really like that aspect of it. I know you mentioned a little bit about the infrastructure, and I want to get into the parks, and I guess a couple of questions, and we can go through them and unpack them, but like curious on like the locations of the parks, if there's like specific areas of the country. And then I have heard of like public versus private utilities, and I find some people might go more towards public utilities versus private utilities. Again, I'm talking to you, you're the expert in it. I have heard of that where people will stay away from one and gravitate towards the other. But yeah, I'm just curious, when you're going through and acquiring these mobile home parks, are there certain states, is there like a certain asset size, maybe a park with 9 lots versus a park with 50 or 100 lots? Just curious what it looks like, what your sort of criteria is when you're going out there and, and vetting these deals.
Yeah, absolutely. So what we do, we use an acronym called, and I did not invent this acronym. I actually got it from a course I took with Frank Rolfe. But it's a great way to look. It really helps me kind of formulate how to look at these things. Is ideal. We're looking for the ideal mobile home parks. That's IDEAL. So not necessarily in this order, but we're looking at infrastructure, density, economics, the age of the homes, and the location. And so what we usually start with is actually the location, because the other 4, if the deal's good enough and you can bring in enough money, you can fix the other 4, but you can't pick the park up and move it. So I think it was kind of an interesting story a month or two ago. I was talking to a broker and I was explaining that there was a market. There's two cities that we really like, and another one, Cincinnati and Columbus are areas I really, really like. We've got a park right outside of Cincinnati. I'd love to have more there. Columbus is great, but there's a city kind of right between them, right next to them, that was confusing me. The city of Dayton, Ohio, and it was the median home cost was half. There's lots of vacant homes. And it was for me, the mobile home park space is really a solution to this affordable housing crisis. So you have to have this affordable housing problem, and then the mobile home parks are a really great solution to that. But so good markets are markets where they have an affordable housing problem for me, because then we're providing a solution. You've got all the demand you could need. If the market's got a ton of vacancy in it, or even if the vacancy is not there, but if you can get a regular home for $100,000, we can bring in brand new 3-bedroom, 2-bath homes and sell them for $70,000. If the median home rent, we're about to close a park in Lexington, the median home cost is $280,000. 70 is a great deal. But if over in Dayton they're 100, and it still costs, it's still going to be 70 is what we can sell it at. It's not as great of a deal. And so I was talking to this broker and explaining I was like, I don't really love the Dayton market. And the broker was surprised, going, man, and this was not a mobile home park specific broker. They were just a commercial broker. But most people say that Dayton's one of the best investment markets in the country. And we started kind of workshopping that. I think what I came up with is if you're buying apartments or houses, you're really looking at that price to rent ratio. So the fact that you can get a house for $100,000 and probably rent it for similar to what you can over in Columbus or Cincinnati means you're getting double the price to rent ratio in Dayton. So you can get houses for cheap and rent them. That's really good from a rental house perspective. Not so great from a mobile home park perspective, where if we want to fill up vacancies, we need to sell homes, and we're competing with the buyers of homes, not the renters of homes, right? So it's just kind of a different way to look at it. So anyway, that's kind of the an interesting little nuance to the location thing. Is a little bit different than the way you look at it in an apartment.
Yeah, no, that definitely makes sense. And now, like you mentioned, like the two, at least for me, getting the 1-to-1, if I'm paying $300,000, can I get $3,000 a month in rent? It was crazy looking. When I was looking in Boston and trying to invest, there was the flip side. It'd be you'd buy the property for $650,000 and you'd get $3,000 a month. I was like, I don't know how anyone's buying these properties. I mean, people, they would sell, and I remember walking through one. It was $450,000, 3-unit, and it was down to the studs. And I'm like, this needs.
Oh wow!
I'm talking 25 miles outside of Boston, where I don't even know if you could get the rent. But yeah, no, it's crazy. Some of these markets out there, where the market I'm in now in New York, it's definitely more of that 1-to-1 or 2-to-1 ratio, which is nice. But I'm curious when it comes to the mobile home parks and the investment returns that someone would see versus investing in another asset class. What does that sort of look like? Is there high cash flow just given the asset class? Is there some sort of equity play in place where a typical multifamily deal might put off say 5% the first year, but it's more value add where you come in, you just turn over the unit, and then obviously renting out and refinancing. But curious what the strategy looks like, or the investment return someone could expect, or I don't want to say expect. Obviously, that's not every deal is going to be similar, but the general rule of thumb, what would be a return someone could think about getting in the mobile home park space?
Yeah, great question. And I think the thing that mobile home parks are well known for is they're known as a high cash flow asset. And that is still true in most markets. They tend to trade at a little bit of a higher cap rate than apartments. That has definitely, that gap has compressed though, as the secrets kind of got out about them. They're the best performing asset class in the last two recessions, both the pandemic and the Great Recession. Maybe storage was right there with them, but they're very, very recession resistant and all these other great things. So the secret's kind of gotten out. So there still can be great cash flow on them, but I think the real opportunity with them is actually in the value add side of it, because there's so many of them. If you drive around and look, there's so many of them that are in great locations and are just ugly. And there's the one we're about to close in Lexington. I mean, it's a beautiful area. They're building a McMansion neighborhood right behind it. There were bulldozers driving behind the fence, building this neighborhood right over there. A middle school's going across the street, rolling hills, horse farms, gorgeous. And the park has potholes. It has overgrown with trees. There's empty pads. Like there's an affordable housing crisis. People need the housing, and there's just empty pads sitting there waiting for someone to bring homes on for people that need these homes. So there's actually, I think the big opportunity with these is actually in the value add side of it. And especially now that it's not 2016 anymore where they're trading at, good parks trading at 10 and 12 caps typically. So I think it's a value add. So you asked about returns. Typically what we're targeting is, I like to see a 5%. If we're going to get, like, the cash flow tends to grow pretty quickly if you can do the value add. So if I can get that like year one returns of like a 5% or 6% and then grow that up into the tens and teens over a couple years, then I'll be looking at an IRR, like a total return of around maybe 15 to high teens. And if it's something that's a bigger value add where maybe we're going to reinvest the cash flows and wait till year 2 to start distributing, then I'm usually targeting around a 20. So for an IRR, if that makes sense.
Yeah, that definitely makes sense. I feel like it just seems more stable to me right now as an asset class than multifamily. Not to say that there's not deals out in the space, but I just seen a lot of operators in the multifamily space where there's just, I think just given the purchase price, I would imagine there's a lot more debt that comes onto it, and there's been a bigger, increase of interest rates and floating rate debt. But how has the mobile home park space fared over, let's just say, like the last 2 years or so? Because I've seen a lot of, and I'm just picking on multifamily. Obviously, there's other asset classes that, but I think that one's taken the hardest hit with people foreclosing on properties because they had floating rate debt. They didn't have, interest rate caps or anything like that, or maybe they want to go buy one, and then all of a sudden all the cash flow is just gone. But yeah, just curious how the mobile home park space has fared over the last 2 years, and then also, like, when it comes to yourself and your company, how you guys structure your deals, whether you do fixed rate debt, whether you just do work with the owner and do seller financing. Just curious what that looks like from one, the last 2 years, and then two, like how you structure your deals, or is on a park by park basis.
Sure. So I guess like the macro side of it, the big deal with the apartments right now is that 2 years ago, when everything was really frothy, they were trading at such high purchase prices that a lot of people, if you wanted to play in the game for the apartment side, especially in the best markets, you had to take that floating rate debt or that short-term bridge debt. And so that's where a lot of the people are getting burned. So the answer on the mobile home park side is most of those are better deals. And so people were doing the variable rate debt has been much more rare. I always go fixed rate debt. So there's not like this big wave of these things come and due that were these bridge debt or fixed rate debt things for mobile home parks. What you have the opportunity in mobile home parks is really the folks who built them all in the 50s, 60s, and 70s. There's still a lot of those folks out there who own them that are like getting old and ready to retire. So that's really more of the buying opportunity in the mobile home parks. And so the other, as far as how they're doing with the apartments, the other issue that apartments are having right now is that rents were skyrocketing. And so a lot of people were underwriting as if the rents were going to keep shooting up, and they got overbuilt, and we had this big glut of supply coming on. And so instead, the market apartment rents have come even flat or down a little bit over the last year. I like to refer to mobile home parks as like the submarine under the stormy sea. If the median apartment rent in the country goes from $2,000 to $1,800, and my mobile home park, to use one of the ones in Arizona as an example, our residents are at 400 and the one down the street's charging 500. We're still just sticking to our business plan. It doesn't, like, our 400, 500 doesn't matter. It's still such a good deal compared to what the apartments are charging that if our market rents aren't really, I don't see them getting affected. The need for affordable housing is still there, and it's still such a good deal that it hasn't really been affected. And sorry, your other question was about like what we're looking for as far as how we structure our deals. Is that right?
Yep, exactly. Is it like more like 10-year interest only loans, some sort of creative financing, just
sure,
fixed rate debt? I mean, obviously way conventional. It's like a 30-year. I think it's like a 30-year mortgage, but I know there's so many different creative financing options in real estate. I'm always just curious to hear how people are financing the deals that they're finding.
Yeah, so we've done several different things. So I've done some seller financing. I'm always looking for that, especially right now with the interest rates the way they are. I'm always at least throwing that option out. A lot of the ones we've done through good banking relationships, so commercial loans through banks, like fixed rate loans. So we'll typically get a 10-year. The one bank that we work with a lot is Five Star Bank, and so we'll get a 10-year loan with them with a 5-year rate reset. So it's fixed for 5. It's got one reset. So it's 5-year basically fixed rate debt at that point. And then the plan, as far as we do it, I like the idea of a really long-term hold. So the goal is to try to get it where we can raise the value and cash out, refi out, so that we can return capital, but then the investors still own it. And so we've returned capital and it's still cash flowing. So it's kind of like a mobile home park version of a BRRRR. We call it our FAIR method. Fundraise, acquire, improve, refinance, return capital, and repeat is our little acronym we use. But basically what's cool is you can take that same chunk of capital when you refi out. It's not a taxable event. And then you can take that same chunk of capital and keep redeploying it and kind of build up a portfolio over time, versus if you sold it and return all the capital, now you've got a huge tax headache with all the depreciation recapture, and you've got to now go find another spot, and you get rid of this property that by that point like the back of your hand. So this seems like this really low risk thing that you're just completely throwing away to start all the way over. So it seems like kind of the best of both worlds as far as keeping your returns high by redeploying most of the capital, but still keeping this at that point low risk asset that you already own and know. So that's the plan.
Yeah, that's perfect. And I thought it was interesting when you mentioned a little bit before, and I can agree with it, looking at like the mobile home parks that drive by just in my local area, and you can see some of them. It's like, wow, like that's really nice and taken care of. And then you see these other ones and you're like, wow, I would not ever want to live there, just depending on, and what I mean by that is like they haven't done any landscaping. The mobile homes themselves just look old and worn down. And then you go to another community and everything's landscaped. All the mobile homes are nice. So I can definitely agree with you there. You just want to have like that nice park where people actually want to live and don't want to let it go. But are there any misconceptions that you find when people are ever thinking about investing in the mobile home park space or mobile home parks, just because it is, a cheaper asset than say your apartments? Do you ever come across anything like that where people might have like, oh, I would never invest in there because maybe the tenant's not going to be as good, or they're maybe not going to take care of their property? Again, not to say that ever happens, but I'm just thinking of just things that might come to mind where people are like hesitant to invest in mobile home parks, just given that it's, typically a lower asset class.
Yeah, I mean it's affordable. It's the most affordable form of housing out there, right? It's the only type of housing that I'm aware of that works without a government subsidy. There's no Section 8 or anything. It just works. A minimum wage family can support themselves. So it does carry a stigma, especially you got all the shows out there like Trailer Park Boys and everything that really paint really. I mean, it's on the one hand it is kind of a funny show, but it paints a very inaccurate picture. So do we have issues with tenants sometimes? Yes, of course we do. Everybody does. The Class A apartments that charge $3,000 a month do too, right? And so my friends who live in the fancy neighborhood with the HOA, they've got crazier stories than we do. But yeah, I think the tenant stigma thing is a real thing. And really what it is, like most of the tenants that we have, almost all of them, they're just good people. They're either old and on fixed income, and so they just have a limited amount of money that they need to be able to live on, or they're trying to support a family and they're not in a high paid career. Our tenants, we've got people that drive. We've got truck drivers. They're the people taking your food to the grocery store, checking you out at the grocery store, pouring your beer at the golf course, checking you in and scheduling your next doctor's appointment. These are all examples of real tenants that we have. These are the people that live there. And so they're just real people that need an affordable place to live. And I mean, when houses are hundreds and hundreds of thousands of dollars, there's lots of people in that camp. And so it's not all just, it's not the trailer park. It's not the Trailer Park Boys scene, I guess is the best way to put it. And you're right though. Like certainly we get that. I was talking to an investor friend of mine the other day. He's in several deals with us, and he was telling me how he's got, he really likes them, but he's got some friends were giving him crap, calling him a slumlord and stuff for investing in mobile home parks. And it was like, I don't know. I felt bad. I was like, I if no one invests in them, then they're all going to be run down. Right? Investing in them is what lets us fix the potholes, make the trees nicer, help the tenants paint the homes, fill them in, provide more housing. If no one invests in them, that stuff doesn't happen. And so there's people that need this housing. And so it is kind of like, sorry, I get a little worked up by when people like you read a lot of these newspaper articles that are really, really misinformed, and just paint all mobile home park owners as like bad guys. And I just think that's really far from the truth. We do our best. Right. And we're providing something that people do need. So
And I think you'd even look again just to harp on multifamily, and you could definitely get some lords in there, especially. I think of the folks in New York City, where I'm a couple hours north of, but you hear a lot of stories come out of there. You see a lot of things come out of there where it's crazy what the people will pay for down there, and what they get, and what won't they
mm,
fix. But I definitely agree with you. It really just comes down to the park operator like yourself coming in and just doing a good quality job for the tenant. But when it comes to your company within itself, how do you guys go out there and find investors for your deals? Are you just tapping on
mhm.
friends, family, current investors? Are you, yeah, I'm just curious what the marketing strategy or the strategy looks like behind it when you're going out there and bringing investors on board.
Yeah, so I kind of used up all my money around 2021 and partnered with my brother-in-law, and we had at first had some friends and family that were like, "Hey, we heard about what you're doing. We'd love to invest, take our money and do it." And so we've done a few 506B syndications, and then this last year I've really tried to focus on the capital raising side. I joined there's a capital raising group called Raise Masters, so I've kind of really doubled down on that. So I've been trying to get on podcasts like this and doing a lot of LinkedIn outreach. To try to meet more investors. So as far as like my marketing to meet people, it's really been largely LinkedIn has been the best source of leads so far for new people. And then on my own email list, we do like a weekly newsletter, obviously each deal we'll do actual quarterly updates with write-ups and pictures and statements and everything as far as what's going on with the deal. But yeah, we've got the weekly newsletters. We've got our list is up to, I think, around 180 or so people on it at this point. So yeah, it's been exciting. It's pretty neat. Like honestly, the fundraising stuff is one of the funnest pieces because you get to talk with people, and out of necessity, I'm trying to assess like where are you at? Are you actually capable of investing? I don't want to take money from someone who isn't, and it kind of leads to these conversations about people's hopes and dreams, and it's really fun conversations where you get to talk to people and get to know them at a deep level. So I really like it. So
Yeah, and I really like just you talking about that, getting to really know them, because I know for me as a past investor, I definitely talk to sponsors and operators, and it's almost like a sales call per se. I feel like they're just trying to take the money, whether or not the deal's a fit for what I'm looking to do, and
mm,
it's not that enjoyable. But I'm curious. I know you mentioned the 506B deals. Are you guys still doing 506B? Are you doing more 506C now? What does it look like on that end?
yeah, so the last one that we did, and probably the way that we'll do for the next few, is we actually did a 506B first for our existing list, and then we converted it to a 506C so that we could advertise it. And we did that because we needed to extend beyond our list, but we've had several people that have been in multiple deals and they're just not quite accredited, and we didn't want to like say like, oh, thanks for staying with us in the beginning and see ya, like you're out. That didn't feel right to me. So it's pretty cool if you do the 506B, as long as you follow all the rules of the 506B, you don't advertise it, you don't generally solicit, everybody's got a pre-existing relationship, and then you fully shut that one down, then you can open up a 506C and then post on LinkedIn and actually generally solicit. So that's probably the way that worked really well. So that's probably the way that the next few we will do.
Yeah, no, I definitely. I hear of some people doing that. It's usually I find this cut and dry. It's like 506B, 506C. So I do like that you have that option where you're helping out the people that aren't that accredited investor, where they could come on and into those deals, and then you bring it over to the 506C. But Corey,
Yeah. To your point on those real quick is I do think the one thing I always like to be careful with, especially if people are non-accredited, is it right for you, right? Like I love these things. There's all kinds of, all the returns and the tax benefits and all that stuff's great, but they're also extremely non-liquid. Any syndication you invest, as you're pulling money to buy one property, it's really, really hard to get your money back out if you decide later down the road you need it. So the one thing, especially on the non-accredited, I always like to just clarify is like, hey, you don't need this. You're not like, maybe you want to do this and maybe you want to buy a house. Like you should definitely make sure that it's money that you're intending to invest for the long term, and you're not going to need it for something else next year. So just something to
yeah, it's
think
perfect.
about.
That's perfect that you said that. And I know for me, it's like it's honestly you're marrying the sponsor for however long, 5, 7 years you're in the deal, because like
Right.
you mentioned, it's not going to be liquid. I mean, maybe you could get your money back, but I mean you'd be diluting your shares depending on 60 cents on the dollar if that's where you're going. You got to just know like, hey, if I'm putting 50K into this deal. It's not my last 50K I have in my life where if this deal doesn't
Right.
end up working out, I'm going bankrupt. So I do like that you brought that overview. But I wanted to say I really enjoyed our interview today. And if our audience is interested in learning more about yourself or your company, where should they head off to?
Yeah, so I've got a free like PDF that's kind of educational on mobile home park investing that'll tell you how to do it and how to do it passively. And oh, sorry, my phone rang. So a free PDF that'll tell you how to do it passively, and I've got that at passivemhp.com. You can get it, and hope to hear from people. I love to chat too, so people can reach me at you can also contact us at freedominvestinggroup.com, and I'm a nerd on this stuff, so happy to answer questions if anybody has them.
Awesome. I'll make sure to include that in the show notes of today's episode. And Corey, thanks so much for coming on today.
All right, thanks, Trevor. That was a ton of fun.